Okay, so we're getting into my favorite risk, interest rate risk. So be real careful on your paper. Some students, when they give the definition of interest rate risk, they give my definition from the notes. That's what I'm looking for. I'm looking for your bank's definition. Right? So I'm like, yeah, I seriously doubt their definition is word for word what I have in my notes. I didn't copy from any bank. So my definition is interest rates change. And you can see we're really specific here. Assets and liabilities, you got to include them both. Assets and liabilities are both impacted. We're talking about banks. So banks are definitely impacted by interest rates on both the asset side and the liability side. And because of that, you have the potential for loss. Remember, we looked at JP Morgan, 3 trillion in assets, 2.7 trillion in liabilities, only 300 billion net worth. They don't have much room for those two being out of whack. And so you got to be real careful on this. If you are a bank, banks especially, life insurance companies even more so, pension plans. We're going to talk a lot about pension plans. There's the big difference between life insurance and banks. Banks are unique in that they have customers on both sides of the balance sheet. They have assets that are deposits, certificates of deposits, those kind of things. Those are liabilities. Sorry, they have assets like auto loans, credit card loans. Those are loans, they're assets to the banks, they're interest rate sensitive. And then they have customers on the liability side, which are CDs, savings accounts, checking accounts. That's pretty unique to happen on both sides. Life insurance companies only have customers on the liability side. So they have regular assets. But life insurance companies buy almost 100% bonds, very interest rate sensitive. Life insurance companies do not buy stocks. We're going to talk about that when we get the pension plans, because I believe pension plans got it completely wrong. You'll have to see if I can convince you on that they do it wrong. And I think life insurance companies do it right. You'll see it's going to be a big essay on coming up. So that's the definition. I don't know what your bank's definition is, but it's possible they won't give a specific definition for interest rate risk because it's going to be under market risk. So it's just going to be an example. But but watch out on their definition of market risk and interest rate risk and those kind of things. Are they talking about assets and liabilities or just the assets? How do they word it? How carefully do they explain that? I don't know if y'all done FAS 115 and FAS 157. If I were interviewing with a bank or life insurance company, I would know those two FASBs really, really well. We're going to talk a little bit about Silicon Valley Bank and how FAS 157 really messed them up. But this was a big deal at UTSA, and I'm sure it still is today, this whole idea of held to maturity, trading, available for sale. Have you ever heard those terms? It was a huge issue at UTSA. So we might get into a little bit how the accounting can make risk look worse or better than they really are. They can somewhat mess up the analysis. So how do interest rates change? So the U.S. Treasury yield curve has 11 points on it. 1 month, 3 months, 6 months, 1 year, 2 years, 3 years, 5 years, 7 years, 10, 15, and 30 years. And if you want to get the yield curve, you just go in to the search and type H15. And it used to be the first thing that came up. Now it's the second thing to come up. I don't know what this first thing is. But the second thing is the Federal Reserve. And they have a data download button. And you just go to download. You can edit the download if you want to. If you want it monthly or weekly or whatever, you can edit that. I do the daily. You can change it, but I'm going to do the daily. And when you do that, you get a good Excel file or a CSV file. And you really can't read it because the titles are too wide, way too wide. So if you want to, you can do sometimes 15 is in there. So This one has 20s. It depends on who you're using, but some of them go back to 1962. Some of them don't. So, if you look at it, oops. The 1 year goes back, but the 2 year doesn't, which is unfortunate because the 2 year is really, really important. So the 2 year doesn't start until 1976. The other thing I don't like is for some reason they put all the holidays in there. And I don't want all the holidays. So you have to sort it, get the holidays out. And there's no like any button say ignore holidays. So all those NDs have to come out. Fortunately, it's just the holidays, not the weekends. But so you just have to sort it. It's pretty easy to do. Just sort it. Sort by one of the ones that has the full data. And I can't tell which one that is. So I'm going to do column E. Go to the column, bottom column E, go up and find, oops. Don't do that. Yeah, I don't have a header. Then you just have to get rid of them. There's a bunch of them. You want to know how many holidays we've had in the last 70 years? There they all are. I guess February 12th is what? President's Day? So if you know your holidays, I don't know what February 22nd is though. What is the 12th and 22nd? I don't know. That's back in 1962. Was your professor alive in 1962? That's the question. All right. So you got all this data very far back. What can you do? You can get the steepness of the yield curve. You can look at volatility and rates on the short end versus the long end. It's on Washington's. That used to be a holiday. They probably changed that from Washington's to President's Day. Yeah, they put them all together, I guess. All right, so I don't know the history back. You can also bring this in and bring in the stock market. You can look at correlation between the S&P 500 interest rate changes. I mean, there's all kinds of things you can do. One thing I'll warn you, if you want to compare this to the stock market, the holidays are not the same. So you have to use a VLOOKUP to line up the S&P to the bond market. Otherwise, you're going to have, I forget which has more holidays, but not all the markets don't have the exact same holidays. So you'd have to look them up. But it's pretty easy to bring it in. You can do some really, really amazing analysis in there. So a normal yield curve is upward sloping. A flat yield curve is just flat. They're all about the same. And inverted is short rates are higher than long rates. And then steep is the same as normal, but just longer term rates are much, much, much higher. So you're in your macroeconomics class, you have to talk about each one of those. So flat is telling you what? Probably the same thing as inverted. Weak economy, Fed's probably going to be cutting rates or they're going to keep them pretty low. Inverted, you're predicting a recession. So we'll see if this last inverted yield curve, we still have an inverted yield curve. We'll see if it's going to predict a recession. Last year, we were 100% sure of recession. I don't know if you guys saw the GDP numbers. We actually had a really good economy last year. So our economy is cooking pretty strong. Most Americans think we're in the Great Depression, but the economy is actually doing pretty well with pretty good, not last year was like 2.5% growth, but last quarter was a very strong 3-point-something% growth. So it's pretty strong growth. That's really strange with an inverted yield curve. So the bond market either has it wrong or the Fed has messed everything up with the quantitative easing, and maybe the historical yield curves don't tell us what they used to. Who knows? A steep yield curve is very positive. People are saying, hey, this economy is strong, the Fed's going to be raising rates. So when you're looking at yield curves, you take your starting yield curve, and your starting yield curve actually helps you predict what rates are going to do because it's telling you something about the economy. So most economic models that use interest rates. They look at that starting yield curve and it influences what kind of scenarios they're going to run. They're not going to just have it removed randomly. If the yield curve's steep, that tells you what's more likely to happen versus if it's inverted. Now, if it's inverted, how does it go back to normal? There's two ways it can go back to normal. Yeah, bull, and we talked about that last semester in bull or bear. So a bull correction is the short end falls. A bear correction is the long end rises up and bond prices falls. So which way does it happen? So which is better? I wrote a blog about this, so you can read my blog, but I kind of copied. I think GMO was talking about it. It is interesting. This last time has been pretty unreliable. I also did this from what rates were when I did this. So this is not really all that normal yield curve when the 1 month is essentially zero. So I didn't adjust for that. You can, there is a really great website. If you just type Treasury yield curve, not the first one, but well, it may be the first one. I'm using a different search engine. Yeah, it's the very first one. So this one's pretty cool. You can go back, like if you're going to look at what was the market thinking before the Great Recession. Well, let me do it. It was pretty steep at the end of 2007. When did it go inverted? You know, that's the kind of thing you're kind of curious about. You can go back to 9/11 if you wanted to. Boy, that's the only thing I like about this is pretty weird looking yield curve. You know, if you want to back to certain periods of time, see what the bond market is telling you something. So it's kind of interesting. If something major has just happened, you can go look at it. What about after the big market crash, what's the yield curve doing? So you're just like, what is the bond market telling us? Why is it that shape? Why are long-term rates so much higher than short-term rates? So the bond market's giving you some pretty good information. So it's really important. You're talking about stress tests on your banks. Most stress tests say, what if interest rates rise 100 basis points? The entire yield curve. What if interest rates fall? That's important to know, but banks, but even more so life insurance companies, it's not just if they rise or not, but which ones rise and by what. Does it steepen? Does it flatten? Does it invert? So your banks and the stress tests, they essentially just shift everything up and down. When USA did stress tests, it got somewhat comical because we were doing up and down 1%, 2%, 3%. We were in a position where one time where interest rates are like 1%. So everybody's like, how do we shift down 300 basis points if we're at 1%? So we essentially just had to stop at zero. Can you imagine what we're doing? They would have had it done in 2020 when interest rates are essentially zero. How do you shift down 300 basis points? So it got interesting and rates get really, really, really low. But there's a yield curve. What's normal for yield curves? So I brought in this file. And I brought in the 1 year, the 2 year, and 10-year. My definition of the yield curve steepness is the 10 versus the 2. And the reason I do that is because the leading economic indicators, that's the one they're looking at. But I also do the 1 year because I have more history. And so what I did here is there's the 1 year, there's the 10-year, and there's the difference. And I got 84. 84 what? Basis points, right? 0.84%. So I got 84, and then I just brought down the history down here. Let's see if this makes intuitive sense. So the absolute min was negative 344. The short end was 344 basis points higher than the long end. And then that happened in a logical year. When did that happen? The early 80s. What was the bond market saying in the early 80s? Double-digit inflation, the Fed's killing the economy. They can get inflation under control, interest rates are falling. So people are willing to lock in a much lower rate on the long end. Why? Well, because they're expecting rates to fall pretty dramatically. Y'all remember? Yeah, well, y'all don't remember, but do you have a guess what interest rates were in 1980?
No, it was like
The 10-year got up into the 15 range. 15%. If I offered you a 10-year treasury yielding 15% today, would you buy it? Yeah, that'd be pretty interesting. So interest rates are extremely, extremely, extremely high, but the Fed was being very effective at shutting everything down. I mean, we went through, I realize you kind of wonder, Reagan's first term, he had 2 recessions in his first term. Because the Fed was just absolutely crushing the economy, but we had to get inflation under control. And the market started believing it. You started seeing this very inverted yield curve. It was like, they're going to get inflation under control and rates are going to fall. So I'm perfectly fine locking in 15% for 10 years, even though I can get 16 or 17 or 18% at the 1 month, because that 15% is going to look wonderful. I remember graduating from college. I graduated in 80s. When did I graduate? I can't remember. Rates were still high. Oh man, there's 16% in there. But I had a CD that matured, so I went to UT Austin, so I actually saved money when I was in college. I won't. Well, I should tell you what tuition was in 1980. So it was $4 an hour. I would buy books for 18 hours of classes, and it would never be over $100. So it was a lot cheaper back then. So I could save my money. I was living at home. So I had the CD mature. I go to the bank and say, I just want my money. So, oh, but we can roll this over. So, well, what? He said, oh, 15%. 15%. No, I don't want, why would I get 15%? So I turned it down. That's how our mentality back then. 15 doesn't sound like great. No, I don't want 15. So rates got really, really high, but you can see the bond market is believing the Fed to bring rates down. And so they're willing to lock in a lower rate long term than they do short term. You can see massive. The max steepness was after the financial crisis of 2008, when we started getting confidence things were coming back, and a lot of people seeing rates rise. But the median, which you should probably have memorized, on the 2 years, 84 basis points. So if you want to think about a normal yield curve, it's when the 10-year is 84 basis points higher than the 2 year. That's a good way to just keep in your mind. I usually say 70, but 84 is a better number. I don't know where I got the 70. Maybe I didn't go back as far. But I'm using the median instead of the average. I don't know if the average is that much difference. We can see, given that both the extremes are pretty wild. Yeah, it's not a big difference. Average is a little bit higher. So 84 basis points. So those are the kind of things, just have out there. So when you see the yield curve and it's the difference between a 10 and 2 year is 20 basis points, hey, we kind of have a pretty flat yield curve. Or if you see it's 170, well, we have a really steep yield curve. Obviously, if it's negative, it's negative. So there's the yield curve. This is the kind of good thing that you could build yourself pretty easily. It probably took me 20 minutes to do this, get some good insight on interest rates. So where are we today? Right now, the spread. See how negative the yield curve got? There's the early 80s, where we had an extremely inverted yield curve because we had 2 recessions. The bond market saying, yeah, things were horrible. I remember coming out of high school, and boy, we were all depressed back then, because the US just looked horrible. Japan was taking over the world. It was the best economy. They're the smartest people. We had all these books about how Japan does everything right. So I'm like coming out of high school, yeah, I guess it's over. I'll be living in a cardboard box the rest of my life. And we're really depressed. And we had these 2 massive recessions. Reagan came into office, and things were, were pretty depressed as we could be. But then things turn around, and you're looking by the 90s, pretty steep yield curve. We had a really steep yield curve coming out of the Great Recession. And then we had inverted yield curve here, which I think is pretty amazing because that's right before the pandemic. And we had a recession with the pandemic, but did the bond market know the pandemic was coming? Or is it just pure random chance that they had that? I don't think this is as much a prediction of a recession because it really wasn't that negative. It was pretty mild, pretty flat. But then we had a fairly this is a very strong, you can see looking historically, this is a very strong indication of a recession. That's a pretty negative yield curve. And we've come back. And why we come back? Well, this is one of those bear flattenings or bear normalizing. You know, the long end rates are coming up pretty dramatically, but we're still negative. We're just not nearly as negative as we were. This is a good chart to have in mind just to understand how markets move. You can see the recession here. You can definitely see the recession here. We have a recession here, so recession. I can't remember if we had a recession in the 90s. I know George Bush Sr. had one. So yeah, you can definitely had a recession in the early 70s. So it's pretty reliable as a predictor. At least it may not be a great predictor of recessions, but it is a great indicator of what bond markets is thinking. And the bond markets are pretty smart people, do a lot of analysis. So I did all of this just off of this H15, just dumping data in. So it's a pretty easy way to look at it. So steepness, usually use the 2 versus 10, how it shifts. You have parallel shifts, everything comes up and down. That's really not what we're looking at right now. Non-parallel shifts, you got the short, medium, and long moving differently. So stress tests tend to do everything rising together, everything falling together, flattening and steepening. That tends to be what we do, just to kind of see the impact. Banks tend to only do the first two. That's probably what you're going to see. Yeah, I'd be curious, and maybe I'll see them doing other scenarios besides just steep and just rising and falling. Life insurance companies are very interested in flattening and steepening because they have some interest rate risks that are quite unique. And theirs is not just if rates rise or fall, but it's the order that they do. So they have to do scenarios where rates fall for a few years and then rise sharply, or they rise sharply and then fall, or they rise and stay up. They have to do all these different scenarios because each one of those has a very different impact on their business. Banks tend to be much more short-term focused, and so they tend not have to run as many scenarios. So here's the two sites I just told you about. So let's talk about what is interest rate sensitive. So obviously bonds are interest rate sensitive. Well, it's going to talk quite a bit about that. So bonds are priced off of interest rates. So we'll get into that. In my investment class, they have to write a paper on the markets, and a few students will talk about how the 10-year treasury yield fell, and we also saw treasury bonds rise in price, as if they're two different things, but they're the same thing. Yields fall, prices rise. You can't have anything else. It's mathematical. If yields rise, bond prices have to fall. So there's a direct link. That's not true with stocks, but that's absolutely true with bonds. Are stocks sensitive to interest rates? So here's that dividend discount pricing model that you used. Dividend divided by risk-free rate plus beta times the market risk premium. What is this thing right here? The capital asset pricing model minus growth. Y'all remember that? The Gordon growth model? There's interest rates right there. So it looks like stocks should be just like bonds. Not only that, but stocks you're going out for infinity, so they have extremely high sensitivity interest rates. That's what you think. So in 2008, interest rates fell. So how much did the stock market rise in 2008? It fell 35%. How is that possible if interest rates fell? So obviously there's something else going on. So there's an implied that stocks have long duration. They're more sensitive to interest rates than bonds, but in the same direction. Rates fall, they should be up. Rates rise, they should be down, but the exact opposite. Why? Because of these two pieces. Why do interest rates fall sometimes? because of recessions and crisis. What happens to market risk premiums and growth rate assumptions during a crisis? They adjust much more to interest rates. All right, we'll talk about this when we talk about pension plans, because I had this debate at USAA. One of the people we met with was saying, yeah, pension plans can have stocks, even though they're sensitive to interest rates. Stocks are sensitive to interest rates. So if you have stocks in a pension plan, they're going to protect you from interest rate risk. And I was like, no, this is not true. That's why I say you can bring in the S&P 500, bring in interest rates, and you can run all kinds of analysis. You can do monthly, you can do quarterly, you can lag it, you can do all kinds of things to see what is the stock market's reaction to interest rates. So it's unreliable because these other two forces have a big impact. Beta does have an impact, but so we're talking about the overall stock market, and the beta for the market's always 1. So if you go into a crisis, interest rates will fall, so that should help the stock valuation. But risk premiums go up and growth rates go down, and that overwhelms everything else, and stocks fall pretty dramatically. Now in 2022, interest rates rose, and what did stocks do in 2022? They fell. There it looked like it worked pretty well. All right. Why? Because of inflation. We're going to see that inflation is kind of the linking pin between stocks and bonds. Real estate. So this is a big project for me at USAA, was to try to figure out how do we so we had to model our portfolios at USAA for interest rate changes. So I had to ask the question, how sensitive is our real estate portfolio to interest rate? USA had like a $3 billion real estate portfolio. And we read an article by a guy named Dan Kashtan arguing that real estate does have a duration. And different types of real estate have a duration. In fact, his argument was, if you got a piece of real estate with a 20-year lease to the federal government, that looks a lot like a bond. You got a fixed cash flow for 20 years, regular cash flow, U.S. government. That looks more like a bond than anything else. Certainly looks more like a bond than it looks like a stock. So a 20-year office lease with a high credit quality, and that just looks like a long, and we can actually calculate that duration and put that into the analysis. If you have a real estate that's a hotel, where they can change rates every night, that sounds like really short duration, like almost a short-term bond. So you can think of real estate kind of bond-like. It obviously has other things going on with it, but it certainly is somewhat bond-like. And the reason I brought this up was our real estate company tended to borrow money always short-term. They always did short-term borrowing, and yet they had these long leases. And so I was just curious. Said, hey, could you calculate the duration of your assets and liabilities? Let's compare them. And they suddenly started matching. And I was like, I didn't want you to, I had no power. I was just a peon analyst, and they suddenly started doing it. So I was like, that's fine. That's kind of cool that they're doing that. I was kind of shocked, but they did have a huge mismatch. Their assets had a much longer duration than their debt. So they started going out longer on the debt, which kind of makes sense. You have a 20-year office lease on a property you got a lot of debt on. You don't want short-term debt where your interest rates are going up and down, and you got this fixed lease. So it does make sense to match it out. So I think what they did made sense. The offsetting to this is real estate is also equity. So you got property value. So if inflation goes up, you might get some benefit there. So there's more noise here, probably less noise with real estate than with stocks, but real estate really doesn't exactly look like a bond. But there is some aspect to that. If you're looking at loans, like banks make loans, that's essentially a bond. So that's going to be the same thing with debt. Firms borrow money. That's going to do the same thing as a bond, except you're going to be on the liability side. All right. So debts and loan is the same thing as a bond. Deposit accounts, we're going to talk about them a little bit. They're tricky. They're really, really tough. I'll talk about what we had to go through at USAA. What is your checking account paying you right now in interest? Nothing. I get like 12 cents a month. So I'm getting college student account. Oh, so it's actually zero? Even if you had 2,000 in there, it'd still be zero. So I don't know. Mine pays me, I get like 12, 13 cents. I think it was 17 cents a couple of weeks ago. So,
You have a minimum,
huh?
you have like a certain amount of money in there?
I always keep 1,000 at a minimum. So yeah, it's possible. Yeah, you can certainly move it to another, but a lot of money is sitting in checking accounts. If your bank went from a 0.1% to a 0.4%, would that interest you? What would it take for you to move your checking account from Frost to Bank of America? What interest rate would it pay on a checking account for you to do that? Would you care? Your checking account is what? It's a transactional account. You have it for transactional reasons. Does it matter? Most people don't notice. So you think of a checking account as being pretty short duration, or is it? And so that's a real tough. We'll talk at USA really struggled with this, and it's really tough. I did this with a credit union. I was on their board. We did the same analysis. Checking accounts, savings accounts, we're not real sure how sensitive they are to interest rates. At some point, they probably are, especially savings accounts. You know, savings accounts are paying 2% and CDs are paying 5%. Yeah, there's people that are probably take money out of savings and move it to the CD, but it's tough. It's really hard to know. There's other things. Life insurance companies have annuities. Those are a real pain. Some of you took my life insurance class last semester. We talked about annuities being like a short straddle on interest rates. They're really dangerous things. And that's because annuities, a lot of people buying annuities are very hot money people. They do watch rates and they do move money around. And that can be pretty tough. So it depends, but this is where it gets complicated. These aren't products you can go out and look at a price because, you know, deposit accounts are they're private, so it can get tough. But you have to make some assumption about them. I remember my desk was right next to the actuarial department at USA, and I remember they were debating this: how sensitive were USA's customers to interest rates when it came to annuities? And these two actuaries, they were screaming at each other. It was a pretty intense debate. One was saying, no, the USA customers, they're very loyal. If our rates are a little lower than bank CD rates or even a lot lower, they're going to stick with us and not going to move. The other guy's like, no, we got a whole new clientele. These are new annuities. We haven't sold this many before. These people, they're going to move as soon as it makes sense. The two of them debating. That's a pretty important assumption to put in a model, because if one of them's wrong and the other one's wrong, they're going to make some really bad investment decisions how to move money. The problem was they didn't sell many annuities prior to 1980. So most of the annuities they sold, they'd never seen before. They didn't have any history. And so they have, you know, I don't know, I think they had $4 billion in annuity. That's, you know, a sizable amount of money. And they're going to make an assumption that if interest rates rise, how many of these customers are going to leave and go somewhere else? And one's saying, oh, about 10%. The other one's saying about 40%. One, no problem. The other one, you're bankrupt. It's a pretty important assumption to figure that out. We're going to talk a lot about pension liabilities, very, very, very sensitive interest rates, maybe one of the most sensitive interest rates that there is. So we're going to do a lengthy discussion of that. But banks, life insurance companies, pension plans, real estate investment trusts, we'll talk about the pension benefit corporation. They're all very sensitive to interest rates. Are there any particular stocks that are really more sensitive to interest rates than others? So let's look. So interest rates are up this year. So I ran my dashboard. So one of my dashboards, I don't know what it says name there, but so one of my dashboards is on sectors. Do you notice any sectors that are negative this year? I don't think consumer discretionary is sensitive to interest rates. So I think that's just noise. But what about utilities? Utilities are very sensitive to interest rates. Why?
They're very stable source of income.
Very stable. And they pay pretty high dividends, right? What about REITs? Pay high dividends by law. They pay 4, 5, 6% dividends. Those are almost bond. In fact, I don't know if it's still true today. For a long time, a lot of senior citizens were buying bonds and utilities and considering utilities to be a bond substitute. So if you can't just say stocks are not sensitive to interest rates. You have to really get down to which sector you're looking at. And utilities are if interest rates rise, utilities almost always fall in value. Same thing with REITs, because people love these 4% dividend yields. That tends to be, if the treasury is paying 5% and the utility is paying 4%, people start saying, well, why not just buy the treasury? So they start looking at that dividend yield as kind of an expected return. So yeah, it's tech stocks are up, consumer service, communication services are up, but that has nothing to do with interest rates. But in consumer discretionary, I think it's just noise. But definitely now materials being down, I don't think materials, you can make an interest rate play on materials at all. I'm not sure what that is. As far as the overall market, stocks, we're back to the growth stock. My value play is just not working, but growth stocks are doing great. Small cap has had a little bit of a comeback, but growth stocks are still outperforming value stocks. Now, is that an interest rate play? That's not what you expect. If interest rates are up, you would expect value stocks to outperform growth stocks, but it's just the opposite in there. That's why I say there's a lot of noise in these numbers. I don't know why Bitcoin is down this year, but Bitcoin is up a bunch this last year. So, it's amazing. In emerging markets, how much is that is China? Because you got China doing badly and India doing well. So China probably dominates that. So y'all know what a dashboard is? You kind of see what this is. You can come into Bloomberg, it automatically updates everything. You can real quickly. What I recommend students do, build your own dashboard. I'm creating a YouTube video to show you how to do this. Create a dashboard and then get a friend, and once a week, maybe on Mondays, get together and don't just look at it, but talk about it. So because it starts getting a little redundant. And then when you go into an interview, you're gonna know exactly what's up and what's down. You're gonna be so far ahead of your competition. And it takes what, 10 minutes, 15 minutes? You load the file, everything's automatically updated. You say, yeah, small cap's still doing well, or wow, small cap really came off. I do the last week, year to date, and then the last 12 months. I'll look at those 3 things. And I'll look at large cap, small cap, value, growth, developed, emerging. I'll look at Japan separately because it's getting kind of interesting. But if you want to look at individual countries, you can. You want to look at India, China, Pakistan, you can do individual countries. You can do interest rates, you can do bonds. I don't have any bonds on here. You can do all kinds of stuff. You don't have 500 things to look at, but if you have like 40 things to look at, and you just start talking about it, writing it down, trying to just in your mind come up with a summary, it will give you I can't imagine you wouldn't be better shaped than 99% of the people you're competing with for jobs, because it just gives you a huge advantage. All right, Kevin, that trading job, those guys know what's going on, don't they? Every single day they do this, just have it. They're there at what, 4 a.m. or whatever, and they're just making sure they know exactly what's going on where. You do that every day in your job for a few years, it's gonna be so second nature. You're gonna know even before you get up in the morning what's going on, because you just get so used to it. All right, so that's definition. How do we measure it? We're going to use duration. Duration and convexity are both important, but we're only going to use duration. So duration it's a real simple formula. If you know how to value a bond, you just value a bond and you weight it for time. It's pretty straightforward to do. Duration is similar to maturity, except for maturity only looks at the very last cash flow. Duration looks at all cash flows and see on average when do you get your cash back. Is it in 1 year, 2 years, 3 years? But it weights the timing by the discounted cash flows. So cash flows that are early are going to be less discounted than cash flows that happen late. So do y'all know the formula for duration? You remember it? It's a fairly simple formula. So if you're not sure, I think I do it in my investment class in one of those videos you can watch. It's really a pretty easy thing to do. I don't think you can do it on your financial calculator, but if you build in Excel, you can do it really quickly. And what duration does is gives us an estimate of how sensitive something is to changes in interest rates through the formula minus duration times the change in yield. That's not the formula for duration. That's how you apply duration. Figure out how sensitive something is. So if something has a long duration, like 10 years, it's going to be much more sensitive than if something has a short duration, like 1 year. And I think some people get a little confused. Short-term rates are much more volatile than long-term rates, but short-term bonds are much less exposed to interest rates than longer-term bonds. So short-term rates move more, but they're less volatile bonds because they're not impacted. Their prices don't move as much. Have y'all seen this formula before? Let's look familiar. Y'all probably will do this. Those that are taking, how many taking John's class, 2E's class? Has he mentioned duration convexity yet?
He said he wasn't gonna be doing it the whole time.
Oh no. Okay.
He said it would go.
He's a life actuary. He could do it a million times over. Maybe that's why he's not going to do it. He's scared he's going to scare you to death. So if a bond has a duration of 5 years and rates rise 1%, then you'd expect that bond to fall 5%. Now, amortizing loans, it gets a little tougher. So like a mortgage or auto loan, you can have a 30-year mortgage and its duration could only be like 10, 11, 12 years. And that's because you're getting not just interest, but you get interest in principal. So it's going to shorten duration quite a bit. So some people wonder, why are 30-year mortgages priced off the 10-year treasury? It's because their duration's closer to a 10-year treasury. They're not a 30-year. You don't price a 30-year mortgage off a 30-year treasury because the 30-year treasury only pays interest until the end, whereas the mortgage is paying interest and principal. So you have to be a little careful. So an auto loan, that's amortizing, right? You're paying interest and principal. So a 5-year auto loan, if the 5-year treasury has a duration of 4.5 years, what would you think a 5-year auto loan would have a duration of?
Like maybe
3, or even maybe a little shorter, because you're getting a lot of cash flow up early. But yeah, it's going to be much shorter. So a bank says, yeah, you got a lot of 5-year auto loans. That's kind of long term, but it's not as long term as you think because they're getting a lot of principal up front. So it's not. It really does skew it quite a bit. So you have several different durations. The CFA exam, if you take that, will cover some of these, not all of them. So you can Wikipedia bond duration. Macaulay duration is the simplest one. Actually, Macaulay duration probably should just be called duration because it's correct. He just forgot to make one little adjustment at the end. I think they should give it to him and just say, call it duration, call it Macaulay duration. But modify just fixes the one little thing he left out. Here's the formula. So very simple formula. This down here at the bottom is nothing more than the value of a bond. You take each cash flow, take its present value, add it up, you get the value of a bond. That's all it is. You'll probably have seen that formula. So you have the first interest payment for how many ends, and then you get principal back at the end. You take the present value of that. The numerator looks exactly the same. What's the difference in the numerator? Yeah, you just add time. So the denominator is just the present value of those cash flows. The numerator is each of those cash flows times its time on a present value basis. That gives you duration. Very, very simple formula. You have the Fisher-Well duration, which I rarely see. Modified duration, using all they do is they essentially take duration and just divide it by 1 plus the yield. Key rate duration, we won't get into that much, but that's something life insurance companies do. And then you start getting into prepayments on mortgages. If that messes things up quite a bit, because what do people do when interest rates fall? They refinance, which does what to duration? Well, shortens it dramatically. Like it could go from 10 years to 2 weeks real quickly. So that complicates things a lot. So that's when you have to use what's called effective duration. So I was hoping John would do some effective duration. So effective duration, you don't need effective duration for a treasury because the government can't pay off its debt early, no matter what Donald Trump said during his presidency. He kind of scared the market, saying he was going to pay off all treasuries at par. Like, no, you really can't do that. That would be a disaster for bond markets. But yeah, the effective duration of treasuries is the same as the modified duration. But for a mortgage-backed security, you don't really know what the duration is because people are going to either prepay their mortgages or not. You don't know. So all the effective durations tells you is what's the impact of interest rates were to fall 10 basis points or rise 10 basis. It's just kind of doing one little scenario, and even that not all that powerful. So it's a tough. Mortgage-backed securities are a very complicated security. They're almost, I think they're probably even more complicated than trying to value stocks. When mortgage-backed securities came out in the early 80s, they were more volatile than the stock market. It took the bond market a while to figure out how to handle these things because there was such a strange phenomenon. Because of that prepay, and you can imagine in the early 80s, what were people thinking? Did people even buy houses in the early 80s? I mean, you should go try a 20% mortgage and a 4% mortgage and see what size house you can buy. It's a pretty massive difference. So you can imagine what someone with a 20% mortgage is doing when rates fall to 15 and fall to 10. They're refinancing every 6 months, probably. It's just a massive impact. I don't know how people afforded houses at that time. It's just very expensive. And so, yeah, it's effective duration is extremely important. Spread duration is brand new. Their spread duration did not exist when I was working. I called my friend at Victory Capital and said, y'all use spread duration? Yeah, we started using it. It's pretty cool. I don't see the point in it, but he couldn't convince me that it's useful. But what spread duration is telling you is the impact on the bond price because spreads go up or down. So if you have treasuries, it won't matter because there's no spread on treasury. It's risk-free, but on a corporate bond, but I don't know how that's any different than regular duration because it's rates. So I don't quite buy it. He was trying to explain it to me. He's like, you're retired, your brain's not working, but I couldn't get into it. You should know what option adjusted spread is. Hopefully John talks OAS. Is he gonna do OAS?
I'm not sure.
If he's not gonna do duration convexity, probably not. So you can see there's a lot of stuff in here, and when you get down into the weeds, there's some articles you can click on where you're gonna like, what language is this in? And it's in English, but it's gonna take you a while to figure out. This is pretty advanced mathematics, pretty tough stuff. That's why we leave it to actuaries and PhDs in math. It's pretty stuff. I always tell students, I had a meeting with some of y'all heard this story before, but I had a meeting with BlackRock, and the head of their mortgage department, and he wanted to show me his new mortgage model. So that's pretty cool. Yeah, let me do that. So he explains it to me. I have no clue what he just said. So I go, and now I'm not following. So he explained it again. I had no clue. He finally just said he has his assistant take me downstairs for cookies and milk, and it's like, see you later. Way over my head. That guy had a PhD in math. He just all that stuff, and that's not. I wasn't a part of it. I think he was talking stuff that there really wasn't. I couldn't figure out because he didn't give me a good foundation of exactly what he's doing, but it was pretty complex stuff. So this stuff gets pretty advanced really fast. And you can do drill down on these kind of things. So we're not going to really get into that. When we do banks, we're going to talk about maybe auto loans. Banks don't really have mortgages because they tend to securitize them and sell them off because they don't really want mortgages. And they don't really keep their auto loans either. But we're just going to ignore this prepayment. I don't know auto loans at prepayment risk. Y'all know anyone that's prepaid an auto loan and refinanced it because interest rates? Maybe in the early 80s you might have done that, but generally it's such a short-term bond and a loan that it's probably not going to be worth it to refinance a 5% auto loan to a 4%. It's only 5 years. So, all right, convexity is the second order change. And the reason you need convexity is because duration itself changes as interest rates change. So if you think about it, if interest rates fall, those longer term cash flows go up in value, so their weight goes up. So as interest rates fall, duration rises. But as interest rates rise, those longer term cash flows get lower present value. So as interest rates rise, duration shortens. And convexity is trying to capture that phenomenon. And this is how, so you have minus duration times the change in yield plus convexity times the change in yield squared divided by 2. So you're squaring a small number. So convexity has very low impact on your bond price unless interest rates change a lot. You have to change a whole lot for that to become an issue. Oh, I say on Blackboard. I need to do a search on Blackboard. So I do have a calculator out there. Down here, Excel duration calculator. So if we do a 10-year treasury, oh, sorry, 10-year treasury, say the coupon's 4%, 10 years, oh, that's not, I'm sorry, I'm not reading my own title. Okay, so it's a regular bond, it's not a zero coupon bond, 10-year, 4%, 4%. So a 10-year bond with a 4% coupon has a duration of about 8 years. Why isn't it not 10 years? Because you're getting interest payments all the way through the time. What happens when interest rates fall? Duration is going to rise, right? Which is really good, right? If rates are falling, you want more duration, and duration rises. So that's what convexity is wonderful. It's what we call positive convexity. Duration is increasing as rates rise, which means you're getting more and more benefit as interest rates rise. I'm sorry. Duration rises as interest rates fall, so we're getting more and more duration as rates fall, so we're getting more and more upside benefit. And if rates rise, duration falls, so that helps us. As rates rise, we're losing money. We're not losing as much because duration is shortening. So that's a huge benefit. And so when you look at it, for this bond here, this red line is what the bond price would do if duration was the only thing that mattered. If it was just a straight line. And you'll notice for duration, it's a pretty good predictor for interest rates don't change much. This is our starting point at 6%. Interest rates don't change much. Duration gives you a pretty good prediction of bond price. What happens when interest rates move a bunch? Duration's pretty far off, isn't it? Pretty dramatically far off. When rates fall, your bond price goes up a lot more than duration estimates. And when rates rise, your bond doesn't fall nearly as much as duration would imagine. The red line is duration. The blue line is the actual bond price. The green line is the bond price with my estimate using my convexity calculation. So you can see it's got a little noise. Why? Because duration's changing, convexity is changing. There's too many moving parts. I can't get it precisely in there. But that's a pretty good estimate, isn't it? That green line's a pretty good estimate. So if you use the calculation. So what's the formula for convexity? I don't know it. You should ask John if he has it. I did have it memorized at one time in my life, but not today. And I'm glad I did because there was an exam question on the CFA exam where they're asking about convexity. And I was like, hey, I got the formula memorized. I'll write it down just to show off. I'll probably miss points on that exam. But convexity is pretty complex. It's a pretty massive formula. You're bound to make errors in it. In fact, Fabosi's book on convexity, he has a math error in that formula because there's just so many places you can type something wrong. So I want to worry about that. You should know the formula for duration. That's pretty important for a finance student and actuarial student to know. But I wouldn't recommend you know the formula for convexity. It's just too massive. I would know this formula though. This is not the formula. So don't get confused. This is not the formula for duration and convexity. This is the formula used to estimate the bond price using the results of the duration convexity formula. So I would know this formula here, especially the first part of it, minus duration times change in yield. That's a pretty important formula in finance. I know how to understand the sensitivity of a bond to changes in interest rates. Now, how do we mitigate it? We mitigate it by something called balance sheet immunization, which is the big math question in exam 1, balance sheet immunization. We're going to spend probably 2 or 3 classes working on this until you get really comfortable with it. So we define interest rate risk is interest rates change, assets and liability prices change in a way that causes us a loss. We measure it mainly with duration. We might throw in convexity, and we mitigate it with this thing called balance sheet immunization. And we are going to specifically do dollar duration gap analysis. I'm going to cheat here. We're going to do this with a bank. Banks don't do dollar duration gap analysis. Pension plans do, but we're going to do this for a bank so you can see how it applied to a pension plan. It's kind of magical and fun, pretty cool. I did it at USAA. It was pretty fun to do. I'll show you. I mean, there's an actual phone call where the broker gave me the duration of the swap. I divided my gap by the swap duration. I said, I want 300 million. I want 500 million, whatever. It would have been a 30-second phone call, except for he kept saying, wait, I think I can get a better price. But if he had the swap he wanted, it would have been a 30-second conversation. He would have told me his duration. I would have told him how much I wanted. We would have said, thank you, see you later. It would have been end of the call. All right. So we'll talk about this. We're using the word immunize and not the fees, because immunize, when you immunize someone, people still get sick. So it's trying to reduce, people take their flu shot, people still get the flu. So you're trying to reduce it. The fees means you eliminate the risk entirely. We're not going to be able to do that. We just have to kind of try to reduce it, try to manage it as much as we can. So it's immunization. And many of you are going to see this, something similar like this in your bank, which is a stress test. Think of this as a stress test, which the bank says, so this is what the board's saying. If interest rates fall 300 basis points, our net worth better not fall more than 15%. You better manage our balance sheet so that if interest rates fall 300 basis points or 3%, we shouldn't lose more than 15%. Same thing, if interest rates rise 300 basis points, we shouldn't lose more than 15%. So the board doesn't know if they're exposed to rising rates or falling rates, but either way, rates fall this much or rise this much, we don't want you losing more than 15%. If interest rates fall 100 basis points, we don't want you to lose more than 5%, or if they rise more than 1%, we don't want to lose more than 5%. What was Silicon Valley doing? They were like negative 40, 50% on rates rising because they were betting that rates wouldn't rise. They were betting on a steep yield curve, not realizing a steep yield curve means rates are expected to rise. And guess what rates did? They rose and they lost a lot of money. Y'all understand this table? Because some students really struggle with this table. Does everybody understand the 300? So if rates today are 6%, what is this thing looking at? 3%. If rates today are 9%, 6%. What is this one looking at if rates today are 5%? What if they go to 8%? So 300 basis points, take 300 divided by 10,000. A basis point is 1/10,000. So 300 divided by 10,000, 3%. All right, so get used to talking in basis points. So this is what we did at USAA, plus and minus 300 basis points, 200, 100. The only time we didn't was when interest rates got so low, we couldn't go that low anymore. And then we just stopped at like 0.5% or something. Now, this implies a certain duration. Because if you remember the formula, minus duration times the change in yield, essentially what they're saying is, if interest rates rise 100 and your duration is 5, you have minus 5 times 1%, that's minus 5%. So the longest your duration could be is 5 years in this scenario right here. And in this scenario too. The longest your duration can be is 5 years, because if your duration were 6 years, you have minus 6 times minus point. Well, here Your duration 6 years, you have minus 6 times 0.03. That's minus 18%. You'd be violating. 6 years would be too long. 4 years would work, right? Minus 4 times 0.03 would be minus 12. You can lose 15, so you'd be okay. So this table implies the board wants a duration of net worth between minus 5 and positive 5 years. If it's minus 6 years, positive 7 years, you'd be out of compliance. If you're minus 3 years or positive 3 years, you'd be okay. What do you think banks are shooting for right now? Exposure to the rising rates or exposure to the falling rates? If you're Jamie Dimon, would you want a positive duration or negative duration? Do you think rates are going to fall or rise here? Well, probably falls, so you might want a higher duration today. You might want to say, hey, what if interest rates fall 200 basis points? We have a duration of 4 years, so we'll make minus 200 basis points minus your 4 years, so your duration is 4, minus 4 times minus 0.02, you would make 8%, right? If rates fall 200 basis points. So do banks have positive duration net worth right now? Possibly. Back in 2020, do you think they had negative duration of net worth? I don't know. You think they were betting on rates rising back then? I was certainly betting on rates rising. I had negative duration in my portfolio, so I was betting. So, you know, what are banks doing? So they don't have to go to zero, and that's why I'm saying this dollar duration gap analysis. What dollar duration gap analysis does is takes you to zero. You have no exposure to interest rates. Banks don't usually do that. They have an exposure. They have some bets they make on rates rising or falling. All right. So we're going to do our first problem. I don't know what time. Oh, all right. So let me introduce this problem. So the first time through, students are like, man, there's no way I can do that. This is way too much. The second time through is like, I'm kind of getting it. And after 2 or 3 or 4 exercises, like, okay, I got it. Stop doing that problem. So it's not as bad as it looks the first time through. So what we're gonna do, I'm gonna give you the steps so you can get a high level. So we're doing balance sheet immunization and ultimately dollar gap analysis, dollar duration gap. These are 2 different things. So balance sheet immunization is you're managing the duration net worth. Dollar duration gap analysis is managing your duration down to 0. All right. So we're going to do both. The first thing we're going to do is calculate the duration, assets, liabilities, net worth. The first thing is calculate duration, asset, liabilities, and net worth. There's a formula. You have to know the formula on the exams. So I don't do any formula sheets. I don't believe in formula sheets. To me, a formula sheet is like giving a medical student anatomy textbook and say, hey, you don't need to memorize the anatomy. You can just look it up. No, formulas are our anatomy, so you got to know it. So no formula sheets. It's a really simple formula too. Then you're going to figure out if you're in compliance and what does the board allow. So are they in compliance? And the last one is what they need to change it out of compliance. Now, the word immunize always means move the duration net worth closer to 0. So if your duration is -4, to immunize, you get -3, -2, -1, closer to 0. If your duration is 4, to immunize, you go 3, 2, 1, wherever. You're going to immunize just means you get closer to 0. Okay. So this is measurement. What comes after measurement? Mitigation. So what is mitigation? So here we're going to do interest rate swaps. I know most of y'all How many of y'all have seen interest rate swaps? Because I know Catapacum doesn't. I do them a little differently than Catapacum. I do it the way I saw it in real life. I can't quite put my head around the way textbooks do it because it doesn't feel like that. Maybe it's because in textbooks, it's like all the parties are together and they're seeing everything going on. That's in real life. I'm only talking to one person. That's an investment banker. I don't know the other side of that transaction. So it's not like I'm calling up someone, hey, you want to swap interest rates? No, I'm calling an investment banker and I'm doing my side of the transaction. It's like I don't care about the other side. So it doesn't feel like it the way he's doing it. So we're going to do it, I think, in a way that this feels more normal. So the first thing we're going to figure out which side a swap to take. We're then going to figure out the ultimate borrowing costs, both sides. And then we're going to do dollar duration analysis, net duration, net worth is 0. So those are the steps we're going to take. It's a really simple problem, but you have to get used to it. So we just have to do it over and over and get some practice. The first time I saw this was surprisingly on the CFA exam. I got really excited. I said, wow, this is magic. It's wonderful. So I came back to our bank. I want to see how they did it. And they had never heard of it. So it kind of bothered me. It's like, I thought y'all did this all the time. Oh, no, interesting. Can you teach us this? And I thought, no, I just learned it myself. But I showed them what it did. I thought it was pretty interesting. So yeah, the CFA exam, I don't think they asked any questions on exams about it. I overlearned it because I just got so excited about it because it's so simple. And it's incredibly powerful as well. We're going to see there's one big drawback, and that gets back to those checking and savings accounts that kind of messes things up because we're not really exactly sure what to do with those things. But if it wasn't for those, this is truly a magical thing. So if you look at the problem that we're going to work on Thursday, I give you a balance sheet, real simple balance sheet, cash, loans. These are pretty long loans, right? You say, well, those look like auto loans. Remember, auto loans don't have a duration of 5 years, do they? That'd be a really long auto loan, wouldn't it? So credit cards have a duration, essentially, of 0 because you can change rates every month. So I don't know what that 5 years is. I just made it up. So they have a really long duration. They have no deposits, so that helps me. I don't have checking accounts. I don't have savings accounts. I just got debt. Debt is very straightforward. The duration of debt is just like the duration of a bond. So that's very straightforward. So what we're going to do is figure out the duration of net worth. And here's the duration of assets. And here's the formula. So you have to learn this formula. Duration of assets minus $1 in liabilities divided by the $1 in assets times the duration of liabilities times leverage. What is leverage? Leverage is assets over net worth. So that's the formula. Not a difficult formula, but you'll see, it's kind of a magical formula. And then we're going to immunize it with a swap. If you've never seen a swap, I'm going to assume you've never seen a swap. And we'll talk about interest rate swaps. I love interest rate swaps. They're magical. And we don't get much magic in finance. So here you get some magic in finance. They're a powerful tool because in one phone call in 10 seconds, you can mitigate billions and billions and billions of dollars of risk very effectively. It's pretty amazing. So next class, we're going to work this. One thing that can really help you in a class like this is go watch the YouTube video that does a practice problem and kind of struggle through that so that you're not seeing it for the first time in class because it only takes about 20 minutes to go through it. But you don't have to do that, but I'd recommend it. All right. So next class, we're going to work these problems, get some practice. All right. Make sure I have you for attendance and for which bank you picked.